If gold prices and commodities did so well in the 70s with interest rates being allowed to move as high as they did back in those days, imagine today where interest rates have basically a limit over them. Because if we see interest rates rise too much, things are going to break. We all know this. You don't need to be a genius just to look at how much debt we have. Things are going to break.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 10th through June 17th, 2024 while supplies last. First, we feature Ital Preziosi Silver Kilo Bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10 ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Tavi Costa, partner at Crescat Capital. Tavi, thank you so much for joining us today.
Thanks for having me.
Well, it's great to have you today. I did want to ask you about the recent pullback we've seen in the metals, with gold trading under $2,300, silver trading back below the $30 level. Should this be concerning to investors in this space, or do you think this is just kind of a breather before we head higher?
No, I think this is healthy. It's good to see some sort of shakeout in the markets a little bit, and in order to see who's got the high conviction to stay in this long-term trend. I think that's absolutely normal. What we've had on Friday, I think, was an overreaction to different things. The labor data, which to me, in my read, was a lot weaker than what was perceived. I think the only way you can twist that as positive is what's been happening with immigration in terms of the new folks coming into the country, which is one of the largest influx of illegal immigrants we've seen in the history. That's certainly starting to add to the labor force, and I think that the market saw that as very hawkish, potentially very hawkish for the Fed. But knowing that the Fed is in a dilemma with interest payments rising as much as they have been relative to GDP, to me, the Fed is going to play the cards as employment and labor market actually showing a lot more weakness than the markets actually reacted on Friday. And so that to me is the main focus. And I can go on why I think the labor market looks so weak. But essentially, the other thing that also happened on Friday was the news that, people call it as the news that China announced they're going to be stopping to buy more gold, and that wasn't necessarily the announcement. There was no announcement whatsoever. All it was a report that shows the official holdings of China in gold unchanged from the prior month, and that was a total overreaction of people already leading to the conclusion, completely premature in my view, that China announced that they're not going to be buying more gold. I mean, if you look at the currency itself, the Chinese yuan relative to the dollar, the more it devalues, the more it forces the Chinese government to actually accumulate gold. And we've seen this trend moving, for the prior years or so. And so I believe that the big imbalances we have in the credit market in China and the real estate and other issues in the banks and so forth only reinforce the reason for folks to own gold. And a reminder that China is not the only one buying gold. There's other central banks that have been also buying gold in a big way. And all we know is the official numbers. Who knows about unofficially how much those institutions are really been buying? I think none of us know precisely how much that is, but we know that given the moves that we've seen so far in the gold market over the last 6 months or so, it gives us the conclusion that and conviction to assume that institutions like central banks have been buying a lot more gold than what they have been disclosing.
Now, mentioning China, it is a narrative that we see. We've talked about it quite a bit about, the BRICS, a lot of the BRICS nations buying gold, and this idea of a multipolar world where the East is going to have a lot more influence. Your perspective on that, because I know you've also discussed and reported on the Chinese economy and how it really is not rivaling the U.S. It's slowing down. They're going to be impacted by a lot of stagflation soon. So your take on that and what it means for the economy here in the U.S.?
I would even call it stagnation rather than stagflation in China. And I think the U.S. is going to face stagflation. But in my view, there is a sort of a misunderstanding of the Chinese economy by most gold bugs that think that China is playing, essentially a game that is likely to be ahead of the U.S. because of the accumulation of gold, while the U.S. is actually continuing to dilute its currency over time and seeing money supply growth now and so forth. But that's, to me, that's not really true. What's really been happening is China is under a tremendous pressure domestically that is causing its central bank to actually buy gold in order to stabilize its currency and so forth. We've seen, and we can look at this by different numbers. Look at what's happening with the interest rates environment in China. If you look at SHIBOR rates, which is essentially the replacement of Fed funds rate here in the U.S., or the same metric, you will see that it's been in a downward trend and one of the lowest levels in history today at 1.9% essentially. When if you look at the Fed funds rate, it's been in an upward trajectory. So clearly, China has been unable to fight either. I don't think China is facing the same inflation problem in the U.S. and other developed economies, but clearly the monetary policy is very different than what we're seeing in the U.S. and other in European countries and other places. The other thing I would point out is there is a good metric of credit creation in China called the total social financing, which we're seeing the first contraction of that metric on a month-over-month basis in the history of that. And I've been following the Chinese economy closely for a long time. And we've never seen that type of metric actually reverse, which shows how they are facing a lot of issues domestically. And one of the things that they've been reinforcing is trying to avoid a further devaluation of the currency, which seems to me inevitable, unfortunately. And so the other issues that we're seeing in the Chinese economy has to do with the labor cost. The labor cost has been drastically increasing recently. And the trends that we're seeing in terms of the reshoring of other developed economies is basically forcing capital out of China in a big way. And so slowly but surely, and I think that the main important point here is that we're not seeing net inflows of capital in China in a big way. And so like we saw in the past. And so these are all big changes in the trends that we saw in the past in China. And in my view, this only reinforces the case for owning gold more in a global stage. As we see China potentially, I mean, if you look at GDP, and I showed the GDP chart, nominal GDP of China going sideways and the US going up drastically. And a lot of people came up to me, well, don't you know that the US is facing inflation? And that's the main reason why you have the separation between the two. I totally understand that. Why don't you look at M2 of China versus M2 or money supply of China versus money supply of the US, where you're going to find that China has double the amount of M2 money supply than the US, however, has a 40% lower GDP than the US. Meaning, if you think the US is printing money, China is doing it in an even larger magnitude. And so those things are the reason why the central bank or the PBOC has been forced into accumulating gold. And I think that trend is only getting started.
So it's interesting. It's not just because China is afraid of what's happening with the US dollar. It's their own currency, too, that is being devalued. That's why they're buying gold.
Well, I do think that there is issues with the US dollar. And I do think that as any central bank that is managing, billions or trillions of dollars in their balance sheet is thinking about the value of holding treasuries versus holding gold. So the gold rush, meaning the transition out of treasuries into gold, is real. And I don't think that that's not real. Now, what people I think are wrong here is assuming that the fact that China is accumulating gold, we should then invest in China because China is a much better economy. Those are extrapolations of the thesis. the reason why China is buying gold and actually transitioning away from treasuries is because they need a higher, improve or enhance the quality of their international reserve in order to improve also the stability of their currency. Any currency in the world is basically anchored by the quality of an international reserve. If that international reserve is shrinking because the value of it is shrinking, or because the deterioration of the quality of those reserves is also declining, which is the case with US treasuries or any other sovereign debt, then what do? You have to replace that with something that has a better value, and gold is providing that or that alternative. But and so I do think that that's a real trend. I think that we're seeing this across many other central banks, and we're going to. This is just the beginning. Like in the 70s, we had close to 74% of central banks own U.S. Gold as a percentage of their central bank assets. And today it's less than 20%. So that trend is only getting started, as I said. I think we're going to see a lot more of that.
No, we have seen gold really take off into all-time highs. Obviously, as we talked about at the top of this interview, we are seeing a pullback now. Silver, I know you had a chart a while back where you had mentioned that silver was breaking out. At that point, I think silver was $24 or $25. Now we've run up all the way to 32, pulled back to 29. Where do you see silver is right now? Do you see a continued run from here? Can you give us kind of a technical overview of what the chart looks like right now?
Well, I think silver is taking its break now, and likely will move a lot higher. We've had gold breaking now, confirming that we're probably in a bull market for the metal. Once that's it has been confirmed, which was when we had that triple top on gold, that I was really discussing that. As to me, it was the main thing in macro assets was watch this triple top in gold. If gold breaks out, that will mark the beginning of a bull market for gold. And as we see the bull market for gold being unleashed, that will unleash other things. And then we saw the copper price doing the same. And then we saw silver doing the same. The thing is, silver is way off from its prior highs. And so if you ask me if this is a real bull market, which I firmly believe it is, then silver is likely in the trajectory of retesting its prior highs. And so in my view, that's inevitable as well. And so I'm paying close attention to that, because I think we're just consolidating a little bit before we move higher. I mean, remember, when we hit 30 in the past 2-3 years, or since 2020, those are sort of peak moments for silver prices. And now we've been kind of establishing ourselves here in this 30 range or so, call it, 28 to 30 plus range. And, I do think that that's a healthy price behavior for the metal. And, if history plays a role here, which always does, I do think that silver is going to lead the way to the upside. And I think it's crazy is that there is this new perception as well by investors that, yes, we're going to see metals lead the way to the upside, but the miners are not going to follow. I don't know anybody who can actually prove that in history that we've ever seen bull markets in metal prices that are not also led and accompanied by a bull market in the miners. And so I think there's a lot of dominoes falling. I don't mean falling in a decline price idea, but really the idea that things are going to move each other. And we have gold already going there, copper is going there, silver is in the process, and the miners are probably the next move ahead.
No, when it comes to the fundamentals, we've talked a lot about that. One of the things you've highlighted, though, about inflation and the money supply is that all around the world, we're seeing increases in the money supply, but at the same time, we're seeing actually a divergence in central bank balance sheets. And what we can put the chart up here for our viewers to see, what is the significance of this, and what does it signal for what's coming ahead?
It's what's forcing central banks to alleviate the financial pressure from having such a levered economy. And I'm referring to most developed countries, which are finally facing inflationary pressure. But given the fact that what I call the trifecta of macro imbalances, where they have the debt problem of periods like the 1940s, the inflation that we had in the 1970s, and also the valuation issue of most financial assets, is causing central banks to communicate a message that they're fighting inflation, but at the same time creating other policies that allow money supply to grow. And I'll give an example. We are all wearing hats of the deflationary period of '08, looking at house prices and saying, oh, house prices are going to collapse and all sorts of things. But guess what? Freddie Mac, for instance, just give you one example, changed the rules of things. So let's just say you have a mortgage, you bought a house, and you're not able to tap into the equity value that has increased over the last 7 years or so of your house, because if you do that, you have to refinance that mortgage at a higher interest rate. Guess what Freddie Mac is about to propose now? They're going to refinance it for you so you can tap into that equity increase, but at the same interest rate that you agreed on years and years ago. Well, that's a change in the rule. We've never seen this before. So governments are doing all these little things to tweak the rules of and it's essentially a fancy way of printing money. You can say, oh, this is not really printing money, but eventually it will cause money supply to grow. And that's essentially what we're seeing in the data. So all these other different policies that they create, I'll give you another one, forgiving student loans. That's not money printing. But wait a second. If you're forgiving student loans, that means, a low income person who used to have a massive debt in their balance sheet no longer has any debt. So, what does that mean? Well, that means that person is going to spend more money. And so all these things are being changed in the sort of process of the economy. And the dynamic is highly inflationary. And so it's almost like running conflicting policies, essentially. And so to me, running in a world where we have all these little things, money supply going way up, and the Fed pretending like they care about inflation, but we all know what's the bottom line. The bottom line is if the Fed starts cutting rates, the last time I calculated, if the Fed cuts rates 3 times, 25 basis points, it would reduce the interest payment by essentially 1/3. And so that's a significant amount. We're probably going to see those things happen. I mean, the Fed is going to, it may choose to go the path of finding ways to justify reasons to take a more dovish stance. And we'll do that because it's trapped. And we all know that. And so to me, there's a lot of ways to kind of play this. One of them is owning hard assets, is owning gold, is owning the miners, is owning commodities in general. There's so many different ways you can sort of, express that view. I mean, to me, it's crazy to see how the positioning for some commodities are so bearish, like oil. Oil is one of the most bearish positioning in the future markets we've seen in the last decade or so. And is that plausible with this environment where we see escalating geopolitical issues and oil itself is becoming more and more of a strategic macro asset? No. Probably oil. I mean, I can come up with many reasons why oil can retest $120, $130 that it was back in June of 2022 during the Russian invasion levels. And so, all these things are kind of, to me, just don't make sense in markets right now, and they're all opportunities. And so, so I pay attention to those little things because I think they're all ways of deploying capital in an environment like today. That I think are going to pay off tremendously for investors.
When it comes to like owning the physical commodities like physical gold and silver, there's not much thought beyond, I can hold it in my own hand or I have it in a secure storage facility. But when you do venture off into these other commodities or mining stocks, as we see the world becoming more conflicts developing around the world, what kind of considerations do people have to make? Does that sometimes, I guess, give you pause, or does it complicate things when looking to invest in different companies?
No, it complicates. I think, nobody can make a massive bet on one asset because we do see things in the nationalization of mines during periods that are very bullish, but all these things are very unique to each asset. They don't happen in a crazy scale across the globe where every government would just, basically do exactly the same thing. When a government chooses to take that route, it obviously also chooses the route of not receiving any inflows of capital from foreign investors. And so it's not an easy decision. A lot of people think it's an easy decision. It's not an easy decision for most economies. Those are usually extreme issues that happen, but they do happen. And so we have to be aware of the risk, the political risk, the geopolitical risk, the jurisdiction risk, and sort of assess that as we allocate capital moving forward. Now, what does that mean? That means really for owning businesses that produce those assets. Now, if you're owning the metal, or if you're owning the commodity itself, that only kind of, I would say, only increases the conviction that metal prices should be going a lot higher. But I don't think that's, I'm not crazy worried about those problems. I pay close attention to them, and I'm coming from South America and living there most of my life, I understand that risk very well. And so I pay close attention to those changes in policies and so forth. But I think I think that the biggest opportunity today is not so much worrying about those risks, but rather thinking about what happens when you have all these institutions that are massively under allocated into those markets like commodities and real assets start to actually deploy capital into that market. That will be a big change to me. Once we see that happening, then I start worrying more about, when valuations get really frothy, I start worrying more about those risks that most people, tend to be worried about. But family offices today, I was just looking at a data, it's very interesting. Family offices in the US own less than 1% of commodities, 0.6%, I think, or less than 0.6% in gold and precious metals. And so, these are numbers that we haven't seen in the past in a very long time. I mean, if you just look at private equity and stocks, for instance, overall stocks and private equity, it makes up close to 60% of their portfolios currently. And so, that gives you a sense of where most of the money has been chasing. And if you look, in the 70s, how family offices used to invest, it almost is, the opposite of that. And so where do we go 30, 10, or call it, I don't even want to call 30 years from now, but let's just call 10 years from now. I think it's going to not look flipped, but it's going to look quite different than what it is currently. Probably less equity allocation, more allocation towards commodities and real assets and businesses that are equities, but that actually are linked to commodity prices. I think that's also going to change the leadership of financial markets, leadership of even countries, because you're going to have countries that have resource exposure that will probably perform better. And so all these things are going to, sort of unlock a lot of ideas that are probably going to play out here in the near future.
It is crazy, just the amount that people are invested in precious metals. It's so small right now. It's such a small amount, precious metals and commodities, where if you just see a tiny flow into them, it could make a dramatic impact on the price.
Yeah, I totally agree. I mean, if you just use an example, how much did gold price, metal prices, commodities went up in the 70s, okay? But that was an environment that interest rates were rising, and still we had commodity prices rising. We all should agree that if interest rates are rising, although gold and commodities can rise with nominal and real rates rising, it is a negative factor. Why? Because it's creating a different vehicle that is becoming more competitive because interest rates are higher and gold doesn't yield anything. So that makes sense. Now, that doesn't take away the opportunity. And what I think it's going to happen in this environment is that imagine if gold prices and commodities did so well in the 70s with interest rates being allowed to move as high as they did back in those days. Imagine today where interest rates have basically a limit over them. Because if we see interest rates rise too much, things are going to break. We all know this. You don't need to be a genius just to look at how much debt we have. Things are going to break. So the fact that we have, a structurally bullish environment for commodities, and people have massively under allocated, and companies themselves have massively also, reduced the amount of capital spending to increase supply, long-term supply of those metals. I mean, this might be the best environment I've ever seen. So when I hear somebody being bearish and telling me, haven't we seen, the prices of the miners over the last 30 years? I don't care what happened in the last 30 years, because what's likely to happen in the next 10 years is nothing like the last 30 years. It's completely opposite. And so to me, that's really where I get excited and why I'm doing what I'm doing.
And if our viewers are interested in this conversation we've had, they can go to crescat.net to find all the latest updates on these topics. Did you have any last thoughts for our viewers here?
No, just pay attention with what's happening with central banks. The fact that the ECB had to cut interest rates at the same time as revising inflation numbers higher, it just tells you everything about how trapped those central banks are. And if you think that the Fed won't do that, I think you're out of your mind. I think the Fed will do that at some point here. And the main reason for that is because interest payments is becoming a more and more relevant issue. And I don't know what elections are going to play here, but both candidates might actually cause those issues to become even worse from an inflationary perspective. And so, I think this is one of the most opportunistic times I've seen in my career, and most of the other things are noise.
All right. Well, Tavi, we really appreciate your time today. Thank you so much, and God bless.
Thanks.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for June 10th through June 17th, 2024, while supplies last. First, we feature Ital Preziosi silver kilo bars at just $1.79 over spot per ounce. We also have a highly limited supply of 1/10-ounce Platinum Britannia at $59 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.